Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for September 22nd of 2025. We're going to start off the chart pack this week talking about the leading economic indicators. You've heard me talk about this in the past. We haven't visited it in a while, but I think we should. We've got several charts here that kind of talk about the LEI. This one in particular is from the most recent release by the conference board, which is in charge of this particular data series. And as you can see here, the LEI, the leading economic index, is in the blue line, and the black line represents the coincident economic index. And so, as you might expect, leading economic indicators will tend to foreshadow what will eventually happen with the coincident indicators. And for the most part, it does, although what we see here very clearly is a deviation from the norm. You go back to really 2000, and you've got in the shaded areas, you have the recessionary periods as defined by the National Bureau of Economic Research Business Cycle Dating Committee deliberations. And you can see here, this is the tech bubble bursting. So we did have LEI that was beginning to roll over at the same time that the coincident indicators were moving higher for a little bit until they in turn rolled over. And so we had many of you will recall, a mild recession, even though the stock market took a much greater hit over that time period. And then coincident indicators moved higher, as did the LEI, and it began to roll over in 2006, 2007. Therein laid the foundation for the global financial crisis. You can see LEI drop dramatically here, as did coincident, and then everything kind of moved forward for quite a number of years until the pandemic, and then LEI again marching ahead. And then for really the last, I'll call it two and a half years almost, we've had this erosion in the LEI at the same time that we've had coincident indicators that continue to move higher. And again, it's not incredibly outlandish to think that that could happen for a period of time, but for it to happen for essentially like 2.5 years is very, very unusual. Here we have the diffusion index, and so this tells us the percentage of the indicators within the LEI calculation, the index itself, that are actually positive. And in this case, it's only 35% of those indicators are actually currently positive. And looking at those various indicators, you can see here, if we look at just the August data, what was helpful, what was not. Obviously, we had a stock market that continued to move higher. We had credit index that was improving. And really that's it for August. And the rest of the indicators here, we had basically manufacturers' new orders on non-defense capital goods and consumer goods, basically a push, no benefit whatsoever. But the areas that were headwinds, I should say, new orders, consumer expectations for conditions, building permits, private housing, all negative here. We got manufacturing weekly hours that were negative, as were the average weekly initial claims for unemployment insurance. And if you look at the trailing 6 months ending in August, you can see the tariff-related impacts here. At least in the read through, you've got expectations that have taken a beating. You've got new orders that are down, and then obviously the housing sector, which we've been talking about for quite some time, affordability being very tight, building permits being down. We got some readings there just recently, and again, you've got these other areas that are just flat, sloppy, and sluggish. On this chart, we have the 6-month growth rate in the LEI in the blue line, and that is overlaid again by the conference board. They have essentially warning signals that are computed in the rate of change in the data. And then if those signals are bad enough, then they're actually recession signals. And you can see here very clearly, going back to 2000, again, this is the tech bubble. Not only did you have warning signals, but you actually did have a recession signal, and you had the recession, which ensued, or actually was basically at the same time that the recession signal was flashing. Again, same thing happened in global financial crisis. You had some warning signals, and then you had your recession signal at the same time that you had a recession. Again, you got to wait till you get to the pandemic, and that happened again. And then look at this. So again, we talked about in that first slide the fact that coincident indicators continue to move higher at the same time that the LEI is consistently moving lower. We've for a couple of years now, we've had these warning and recession signals that have been unfulfilled. We just haven't had a recession. 2022 and even 2023, we felt like there were certainly the conditions for that, but it just didn't happen. Now we're going to talk about gold for a few slides here. We've got gold prices, which we know are at or near highs. You can see relative performance to the S&P 500, very impressive here. So this data series goes back to 2020. You can see number of years where gold performed, in a relative basis, it performed okay, but not stellar. That has certainly changed. So, and especially if you look at gold relative to foreign stocks, as defined here by the MSCI World Index, excluding U.S. stocks, you can see gold particularly poignant in its outperformance here relative to foreign securities. On this slide, we have Chinese central bank making a bold move into bullion, and certainly at the same time, it is reducing its holdings of U.S. Treasuries. You can see here very clearly, even as recently as call it like 2015, that this gold acquisition spree was really in force. And again, as China got admitted to World Trade Organization, that became kind of a thing. And they increased their supply of gold, and so this is clearly a prolonged move and a very strategic move on the part of the Chinese central bank. On this slide, we have correlations, which I think are really important when we talk about gold still being a method of diversification within a portfolio, and most of our portfolios do have gold in them and as part of the alternative sleeve, if you will. And you can see here the reason why. So, let's talk about gold correlations to major assets. And if you talk about the gold's correlation to equities, it's basically zero. So there's no correlation. When you think about, something that might have a 1.0 correlation, that means that they move in lockstep. And that's not what we want from gold. When equities are down, we want gold to be outperforming, and we're willing to accept some diversification when things move the other way. But in this case, gold has very little correlation to equities, and incidentally has relatively little correlation to fixed income, and that has not been the case for probably about 3 to 5 years before the pandemic. But you can see now the correlation is very, very low. And then also the correlation to inflation is extremely low. So gold as a diversifier is still every bit the benefit that it was 10, 20, 30 years ago. Here we have another chart on gold as we kind of conclude this conversation. You can see as we talked about, gold is really punching close to $4,000 an ounce. Spot prices in the gold line here. Inflation adjusted prices in the black line. Again, gold really catching a bid here. You've got persistent inflation related to tariffs. You have some uncertainty. Those are generally good things for gold when you look at spot prices. Now we'll talk about assets and money market funds, and this is something that has been, it's been a theme for many years now, and you can see the consistent rise in assets, and we're now about $7.7 trillion in money market funds. This is I think in many cases, dry powder for the stock market. And this liquidity is one of the reasons why we have such staying power in the market right now. Even if, in the instance that we're seeing here recently, that we've got these money market yields in 2025 that are moving lower. And right now, I think in this chart, which I believe is probably about 30 days old, the numbers are actually down closer to 3.75 now on money market yields. Now we'll talk about basically infrastructure spending as it relates to data centers and power demand, and this general theme. Now we've taken a little bit bolder stance lately on infrastructure spending in terms of the investment reallocations that we're making, and reading the data, it's pretty compelling. I mean, you've got basically artificial intelligence, and in this slide, this is actually from McKinsey, that modern AI workloads will need a lot more power. And you can see, in what is evolving ahead of us. And so 2026 relative to 2025, and certainly 2027 relative to 2026, that the power demands are going to be outstanding. Now we talk about electricity consumption. Now this is broader implications on a lot of different areas, particularly with respect to housing growth and community growth, and I mean, we're having to look at alternative sources of energy, and in addition to kind of the traditional channels. Of course, you've got coal-fired power generation. You have some of the emerging green energy like wind and solar. But now you have in the conversation, these small nuclear reactors, SNRs, that are going to have to, I think, come into play here, because you look in the shaded areas, both rest of the world, outside of the U.S. and then within the U.S., that AI is presenting a pretty tremendous challenge from a power generation standpoint. So this is capital expenditures by what we're calling the hyperscalers, and this is out of Goldman Sachs research, and you can see here that we don't necessarily have all of the data back in from last year yet, but clearly the trend is up, and so there's going to be a lot of spending going on in infrastructure, and not just in power generation, but a heavy part of it is going there. But I think this is a trend that's got some serious legs to it, and will be something we're going to be talking about for quite some time. More Goldman Sachs research here. This is global data center demand, and you can look at AI as it's depicted in this chart. We've got a 98% 4-year compound average growth rate, and you can see that depicted here in a fairly linear growth pattern, respective to the hyperscale and the cloud environment, and you've got the non-hyperscale cloud, basically the kind of the base infrastructure layer here, which is not growing that much, but all of this being driven really by advanced technologies and AI. Now we're going to switch and talk about a few different things, economic related. This one, tariff revenue. Odd though it may sound, tariffs have generated a tremendous amount of revenue here, and right now we're talking about something north of $350 billion here in 2025. And so, again, I'm not making a political statement, and I would tend to say that I'm much more of a free trade proponent, and so as a consequence, I'm certainly not a fan of the tariffs that we're seeing. But let's face it, they are generating revenue, which, as we'll see in the next slide, in its relative importance, is actually pretty strong. So this is tariff revenue as a percent of household income taxes that are paid. You can see here again, with the revenue going up, that we're basically these tariff revenues are basically equal to about 18% of all household income taxes that are paid. On this chart, we have kind of a trend in imports in various components, and you can see in many respects, you've got more capital goods that are basically taking the place of consumer goods. Consumer goods are, I guess, more wants and needs. Capital goods have more to do with maybe kind of capital spending or things that you've got to have, like washer, dryers, and refrigerators and things like that. You can see very clearly in I guess, admittedly somewhat noisy chart here that you've got food and beverages kind of, basically flat to slightly down. You've got automotive vehicles, which we know have been a little challenged lately. You've got industrial supplies, which have been in a downtrend with a little bit of noise here lately. And then clearly consumer goods, you've seen a material downtick at the same time that you've seen that uptick in capital goods. We've got data for consumer spending. We see growth is slowing over here. This goes back basically handful of months. You can see, Liberation Day in April here. And, again, I'm not going to make a mountain out of a molehill here, but just say that the trend line is down. And I think it's going to be very important when we sit here and I'm doing this analysis about 2, 3 months from now, as we're on the eve of 2026, to see where consumer spending is, because that really is the driver of our economic growth right now. Something else I wanted to spend some time on is the private capital markets. You can see here that venture cap deals, that a very large percentage of these VC deals over the last couple of years are tied to AI or machine learning. You can see here in North, and this is broken out by region. So North America clearly has seen upticks, and you've also seen it in Europe. Not so much necessarily, Asia, Latin America, but certainly in some of the key areas of the industrialized world, you're seeing a tremendous amount of activity from the venture cap community within those two key areas. As we're sitting here about a month out from third quarter earnings, we want to take stock of where earnings estimates are going. And, coming out of the second quarter, we had a pretty strong beat. Earnings estimates were moving higher, and that was following a period where estimate revisions had been coming down consistently for quite some time. The fear of tariffs, impacts, and whatnot. So, I would say in this chart, again, from Apollo Management and Torsten Slock, that if you look at the overall S&P 500, and particularly like the Mag 7, you're really not getting growth right now. In fact, you're looking at negative trends in consensus estimates, and where we're getting all the juice right now is in that Mag 7. Partially due to some of the data I've shown you here today. And capital spending, obviously, they're generating a lot of surplus and free cash flow. And the requirements are certainly there. So, you're getting a lot of earnings growth out of that particular contingent, but the rest of the index is really kind of lagging behind. Here we have global equity valuations. We talk a lot about the U.S. valuation. This is a slightly different metric, but no less important. So it's basically measuring the world stock market capitalization as a percent of global economic growth. And in this case, we're about 120% of that. And this is masking the little trend here, but we're not actually at a high, but we're very close to it. And you can see basically going back to global financial crisis, we've been in this, pretty reasonably defined uptrend in valuation growth. But suffice it to say that global valuations, non-U.S. global valuations relative to the U.S. are still heavily discounted. Then we have tech earnings. You can see here, this is basically U.S. technology earnings. And again, why the stock market is a big reason why it's moving higher, a big reason why the stock market is witnessing earnings expectation expansion is right here. you can see the world ex US that those earnings are fairly benign. And so US tech is really driving a lot of the enthusiasm in the capital markets right now. Here we have European firms and their net investment relative to the US. This is something else that I think is very, very interesting. And I think it actually lends itself to continued outperformance from the domestic markets. You can see capital spending is much, much higher in the US than we find in Europe, even though some of these inflection points are the same. Again, pandemic, we're moving kind of up in the US and kind of flatlining here in Europe. But again, that's a pretty stark divide right now. And again, I think it lends itself to continued US outperformance. Last two slides here are ones of kind of relative personal interest to me. First one here really kind of measures the cost of natural disasters, and you can see that that number continues to go up. There's obviously renovation and replacement costs that are certainly higher than they were 10 years ago because of inflation. And also when you think about the remediation of properties that are damaged in some of these instances, I mean, you've got, tariff impacts on, imported lumber and things like that that are driving these numbers higher. When you think about, how this ties back to how risk is priced and the availability of certain coverages, it does tie back to the consumer sector. And you think about, what their price basket is and their cost of maintaining your household. Obviously, maintaining, coverage for risk is very important, and that just seems to continue to want to move higher. And finally, here we have a slide just showing the age cohorts for users of artificial intelligence. Not too surprisingly, you've got kind of the old guard here that are using it, but only at a very minimal percentage. Whereas you've got the rising professionals and those that are really just beginning their careers are much more avid users. And so this is not terribly surprising, but again, as this generation rises up, I think you're going to see the desire to want to drive more AI within core business processes. And I think when you think about this, this group 5 years from now, we're going to see, I think, productivity gains, some real productivity gains from AI that is relatively hard to quantify right now. That's all we have for this week. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.